Okay, let's unpack this. Have you ever seen a company hit the reset button completely? It's like a high-stakes corporate chess match,
Hmm.
where every single move fundamentally redefines its future. Today, we're taking a deep dive into Nano Dimension, ticker symbol NNDM, a company that's been in, well, a whirlwind of change, from dramatic leadership shifts to a complete overhaul of its strategic playbook. Our mission: to distill the most important nuggets from their latest financials, management strategies, and future potential, giving you a crystal clear picture of where they stand, what they've learned, and maybe, just maybe, where they might be headed.
Yeah, and what's truly fascinating here is just the sheer speed at which a technology company's landscape can shift. It's pretty incredible. Nano Dimension has moved from an era of, let's say, aggressive expansion to a much more disciplined, financially focused approach. Our deep dive today will really illuminate the tangible impacts of these shifts, from their balance sheet to their competitive positioning, and highlight some critical considerations for anyone tracking this space.
It's exactly. We're going to explore how they're shedding what's not working, what they're clinging to as core assets, and even some very recent news that could redefine their corporate structure yet again. So, if you're curious about the intricate dance of corporate strategy, financial health, and the future of digital manufacturing, stick with us. So, let's start by setting the stage for Nano Dimension's dramatic journey. This isn't just a gradual evolution, right? It's a profound pivot. It began with some serious upheaval in leadership and strategic direction.
Indeed. Their CFO, Asaf Zipori, put it quite directly. He said they're shifting from chaos to discipline.
Hmm.
That's not just like a colorful phrase. It signals a complete reorientation, a fundamental change in how they operate and what they prioritize. For any tech company, that kind of deep strategic shift is critical for both short-term survival and, well, long-term vision.
Right. And to truly grasp this pivot, you have to look at where they came from. Think back to Q4 2023 under former CEO Yoav Stern. His vision, it was all about rapid, aggressive growth, consolidation. He celebrated 2023 as a fantastic year, boasting a 29% revenue increase, improved gross margins. His strategy was fueled by this significant cash position of $1 billion, ready to be deployed for acquisitions, R&D, even while burning, what was it, $10 to $12 million in cash each quarter. He highlighted prestigious customers, NASA, the U.S. Department of Defense, framing Nano Dimension as operating this vast business domain, not just a conventional industry, heavy emphasis on software, AM innovation.
Yeah, and then fast forward just a year to Q4 2024. Under former CEO Ophir Baharov, the narrative completely changed. Baharov described 2024 as a year of transformation, squarely focused on execution, financial fundamentals, and we saw immediate, tangible actions. The company exited non-core units: Admatech, DeepCube, Formatech, Fabrica. This move, which interestingly was championed by activist investor Murchison, led directly to a significant $20 million cut in operating costs. It was a clear, decisive shift from pursuing sheer scale to prioritizing sustainability, measurable results, not just abstract visions anymore. They even highlighted a major increase in revenue per employee, jumped from $147,000 to $223,000. That signals a laser focus on efficiency, getting more from existing resources.
So under Stern, it was all aggressive growth, that $1 billion war chest, this grand, expansive vision. But you have to ask, was that approach sustainable? And was the market even rewarding that kind of expansion then? Baharov's approach seems like a direct response, doesn't it? And while both leaders saw software as important, their applications differed quite a bit. Stern saw it as reshaping an entire industry. Baharov zeroed in on Markforged's platform as a near-term valuable asset, much more focused. But here's where the story gets its latest twist. Just from September 9, 2025, Nano Dimension announced David S. Stellan as its new CEO. He joined the board back in February 25, brings over 40 years of tech leadership experience, and he replaces Ofer Baharov.
Right. And this latest leadership change, coupled with the board initiating a process to explore strategic alternatives to maximize shareholder value and engaging Guggenheim partners and Houlihan Lokey as financial advisors, that indicates an ongoing active reevaluation. The transformation is clearly far from over. It really begs the question, what does this mean for those prior strategic shifts? And how will this new leadership team with these advisors steer the ship towards maximizing shareholder value? It just underlines the continuous dynamic nature of corporate strategy in this high-tech sector. It's never static.
That is a huge development, and it really underscores how this new leadership isn't just, tweaking things. They're scrutinizing everything, especially those big acquisitions from the previous era. So what does this discipline mean for giants like Desktop Metal and Markforged that they brought into the fold?
Management is absolutely putting their portfolio under a microscope now. Markforged, for instance, seems to be considered a strong asset, primarily due to its valuable software and its broad installed base. It seems to fit well into this new, more focused vision.
Okay, but then there's Desktop Metal. CFO Asaf Sapori bluntly called it the elephant in the room. This acquisition, remember, was done under court order, cost Nano Dimension nearly $180 million to Desktop Metal shareholders. The concern here is significant. Desktop Metal came with $115 million in outstanding convertible notes, essentially debt that can be converted into equity, right? All incurred before Nano Dimension acquired it. So Nano Dimension didn't just inherit a big financial obligation, but also potential dilution risk down the line. And Nano Dimension has explicitly stated it has not committed to any additional funding beyond some limited secured financing.
Exactly. Any future involvement with Desktop Metal is going to depend entirely on a clear strategic fit. They've made that clear. Management expects to have clarity on Desktop Metal's strategic review by the end of June 2025. So, fairly soon. It's a classic case, isn't it? Like buying a beautiful house only to discover this huge hidden lien that suddenly becomes your problem. Nano Dimension is now grappling with the ghost of a prior owner's debt. That complicates every move they try to make. This really highlights the tension, between those past ambitious growth strategies and the current push for disciplined execution and profitability. Internally, leadership site visits have apparently already revealed opportunities for cost saving, role consolidation, streamlining offerings across the acquired entities. This cultural reset is aimed not just at improving margins, but also, hopefully, unlocking innovation by reducing some of that organizational friction.
So it's clear they're not just buying companies anymore. They're dissecting them, seeing what truly fits this new discipline model, and figuring if they can mitigate those past financial liabilities. But for any investor, the ultimate proof is always in the financials, right? The statements. So let's move from strategy to the cold, hard numbers. Let's see what the year-end 2024 statements reveal about this pivot.
Yeah, these figures are crucial for understanding the tangible impact of their chaos to discipline approach. Do the numbers actually back up the narrative?
Absolutely. Okay, first, revenues. They increased a modest 3%, up to nearly $58 million in 2024. Management attributes this to increased and more effective sales efforts. Sounds like a positive sign for their focused sales strategy. However, gross profit saw a slight decrease, down to just under $25 million. This was primarily due to a write-down of inventories from those discontinued Fabrica product lines, which really underscores the direct cost of making those strategic divestments.
And that's a direct reflection of the strategic shift we talked about, right? Moving away from non-core assets. Now, let's look at operating expenses. This is where the cost reduction story really takes shape. R&D expenses. A dramatic 40% reduction. They cut deep into payroll, materials, share-based payments. Sales and marketing expenses also down by 15%, similar reductions there.
And general and administrative expenses, G&A, saw an even more dramatic drop, decreasing by 31%. A huge part of this reduction came from cutting professional services, largely tied to the legal and advisory expenses from those past shareholder proxy contests, remember those battles, where activist investors were vying for control or influence on the board. These are definitely clear indicators of their aggressive cost-cutting.
And as a direct result of these significant efforts, their operating loss improved dramatically, decreased by 31% to $86.4 million. This is directly attributed to the reorganization plan executed in the fourth quarter of 2023 and other cost reduction efforts taken in 2024. So this clearly shows core operational performance getting leaner.
Okay, now, despite those clear operational improvements, there's a critical financial detail that really jumps out. The net loss actually increased, up to nearly $97 million in 2024 from $55.6 million the year prior. That seems counterintuitive, doesn't it? What's driving that discrepancy?
That's the key question, definitely. This increase in net loss, despite better operating performance, it's primarily due to a significant jump in finance expenses. Over $53 million in 2024. That's a dramatic increase from just $1.6 million in 2023. Additionally, other expenses net, which included those Desktop Metal and Markforged transaction-related expenses, also contributed. So this tells us that while core operations are indeed getting leaner, the financial fallout, interest payments, integration costs of past acquisitions, they are still significantly impacting the bottom line, despite the company's best efforts. It's a reminder, really, that past strategic decisions cast a long shadow.
That's a critical distinction for anyone looking at NNDM. Okay, moving to cash flow. We do see some positive trends emerging here. Net cash used in operating activities decreased substantially, from $105 million in 2023 down to $57 million in 2024.
That's a positive trajectory, yeah. showing much more efficient use of cash in their day-to-day operations. And investing activities shifted dramatically from using $166 million in 2023 to actually generating $140 million in 2024. Now, this was primarily from changes in bank deposits and interest received, which implies perhaps a more conservative approach to capital deployment, maybe even generating income from their remaining cash reserves.
In terms of liquidity, the company acknowledges it hasn't achieved profitability yet, and it expects operating losses and negative cash flow in the near term as it continues to invest in R&D and sales marketing. However, they believe current resources are sufficient to meet our business needs for at least the next 12 months.
So kind of a mixed bag, wouldn't you say? Progress and lingering challenges on the financial front. So we've seen the internal shifts, the financial impact. What are the experts saying about Nano Dimension? What's on the horizon for their target markets?
Well, current real-time analyst ratings for NNDM are pretty scarce, actually. But the industry is keenly focused on the forecasted annual earnings per share for December 31st, 2024, which currently stands at a razor-thin 0.01. Now, that might seem small, but for a company that's been bleeding red ink for so long, it would be a symbolic and pretty critical step towards proving their discipline can actually translate into profitability. A slim profit, yeah, but certainly a step in the right direction if they achieve it. The company is clearly targeting specific high-value markets now. They plan to strengthen their presence in 4 core sectors: aerospace and defense, automotive electronics, and medical. These align very well with their capabilities and the strong demand for complex, high-performance parts in those areas.
This points to a company betting on a future where additive manufacturing and specialized electronics production become mainstream, moving beyond just prototyping. They're positioning themselves in sectors that demand precision, reliability, custom solutions areas ripe for their advanced technologies.
And the market opportunities in these areas are substantial, aren't they? The additive manufacturing market, for instance, expected to grow from $12 billion to over $22 billion by 2029. That's a CAGR of 13%. Printed circuit board manufacturing equipment, projected to reach nearly $12 billion by 2028. And surface mount technology, SMT, expected to grow from $6.1 billion to over $9.5 billion by 2030, an 8% CAGR there.
Yeah, those are robust growth forecasts. And Nano Dimension is trying to position itself strategically within them. They're differentiators. A strong focus on sophisticated technologies, precision manufacturing, high-performance materials, advanced software, crucially, including machine learning and flexible SMT solutions, specifically for high-mix, low-volume manufacturing. This vision, combined with their internal cost-cutting, suggests a really focused effort to capture specific high-value segments of these growing markets. It's about being precise in their targeting, rather than that broad acquisition strategy of the past.
Okay, every deep dive needs to include a look at the potential pitfalls and the ever-changing regulatory landscape. So let's talk risks and regulatory changes.
This is a critical area, definitely, especially for a company in such a significant state of transformation. The strategic shift itself, moving away from aggressive acquisitions to a core business focus, that's inherently challenging, and as they admit, may be unsuccessful. And the divestments, while strategic, can cause material disruptions to operations and revenue, at least in the short term.
That makes sense.
Yeah.
Shedding assets isn't always a smooth process. And then there's the ongoing uncertainty surrounding Desktop Metal. Its significant liabilities mean that Nano Dimension's ability to retain or integrate its assets is affected by the outcome of that review. There's even a risk of additional expenditures or, in a worst-case scenario, bankruptcy proceedings for Desktop Metal itself. That's a heavy cloud of financial and operational uncertainty hanging over them.
It absolutely is. And beyond those internal strategic risks, they're facing a host of regulatory hurdles. Critically, Nano Dimension entered 2 interim national security agreements with CFI US back in April 2025, related to the Desktop Metal and Markforged acquisitions. CFI US, the Committee on Foreign Investment in the United States, reviews foreign investments for national security implications. These aren't trivial. These agreements impose stringent compliance requirements for supply assurance, product integrity, information protection, cybersecurity audits. Non-compliance could lead to penalties, which means significant ongoing operational and financial commitment for Nano Dimension.
And here's a big one for you as an investor. Nano Dimension expects to lose its foreign private issuer status by June 30th, 2025. This is due to its U.S.-based acquisitions and leadership changes. What does that mean in practice? It means more stringent SEC and NASDAQ reporting requirements will apply, starting January 1st, 2026. This isn't just paperwork. It signifies a massive increase in oversight, compliance costs for the company. It's a big deal.
And it begs the question, How will the company manage these intensified regulatory burdens and ongoing legal challenges while simultaneously executing a complex strategic pivot and evaluating major acquisitions? The shift from a foreign private issuer to a domestic registrant, in particular, means a significant increase in oversight and compliance for U.S. investors. It requires a robust internal infrastructure to handle that new level of scrutiny and accountability. It's a major operational challenge, no doubt.
There's also the belief that NNDM may be a passive foreign investment company, or PFIC, for U.S. federal income tax purposes in 2024 or future years. Now, this PFIC status is a serious consideration for U.S. investors. It can trigger really complex and unfavorable tax consequences, making your investment significantly less attractive unless you navigate very specific, often difficult tax elections. And critically, the company has stated it does not intend to notify U.S. taxpayers or provide information for these elections, placing the full burden and risk directly on individual investors. That's tough. Plus, some products use AI, right? And the evolving regulatory framework for AI could adversely affect the business. And let's not forget the U.S. trade tariffs implemented in 2025 could increase import and supply chain costs, potentially squeezing margins.
And finally, they're still involved in ongoing legal battles. This includes litigations regarding the DeepShoe acquisition, the Stratasys takeover bid, and some remaining Murchison-related matters, though some of those Murchison cases have been withdrawn. These legal entanglements just add another layer of complexity and potential cost to their transformation journey, diverting resources and management attention.
So what does this all mean for you, the investor, or simply the curious observer? Nano Dimension is clearly a company in a profound state of transformation. From a prior era of aggressive expansion, they are now seemingly laser-focused on discipline efficiency, finding a clear path of profitability by shedding non-core assets and strategically reevaluating major acquisitions like Desktop Metal. The latest news, a new CEO, and a fresh strategic alternatives review mean this journey is far from over. It's certainly one to watch closely.
Indeed. This narrative highlights that constant tension, doesn't it, between ambitious growth and sustainable execution. While their financials show an improved operating picture for 2024, that increased net loss due to transaction costs, and the looming questions around Desktop Metal, combined with the significant regulatory changes they face, especially losing their foreign private issuer status. It all presents a complex challenge. Their success will hinge not just on technological innovation, which they have, but on meticulous execution and navigating these significant external pressures.
So as you consider Nano Dimension's path forward, here's a provocative thought for you to mull over. In this era of rapid technological change and increasing geopolitical complexity, can a company truly find its discipline and achieve sustainable growth if it's still untangling the financial and operational threads of its past aggressive expansions?
That's a great question to consider. Thank you for joining us for this deep dive.